see what happens. Oh, and then every once in a while tell me to shut it off, because the computer really doesn't like an hour long. Or 15 minutes. So you pick a time that's a really good break. I don't mean a break for you, I mean a break in the logic of what I'm doing. That's impossible because there's no logic of what I'm doing. It's there. It's bounced all over the place. Okay, anyway. So we've done part of this problem, you guys. Provide the complete accounting equation. We got it, right? I indicate which accounts are the balance sheet, which are on the income statement. We got it. Oh, perfect so far. Okay, indicate how to increase or decrease each account, debit or credit. And again, what does debit mean? Left. What does credit mean? Right. This is ridiculous, isn't it? How bad do I want you to know that? The last day of class, if you don't know that, I will be giving you a D or an F. Got it? Gotta know it. And you do, don't you? Okay? It's really sad is during the regular school year, particularly in spring. I know it is about spring. I'll have people that just refuse to get it. Just refuse. They refuse to read, they refuse to do problems, they refuse to listen when they come to class. They do come to class. Element students are really good about coming to class. But like I said, I can sleep with my eyes open, right? Not learning anything. I'm good at it. So if I go to a meeting where I don't want to be there, I'm good at that. Okay, so you guys tell me. Assets, how do you increase them? With a what? Increase them with a what, guys?
Debit.
Debit. Why? Because they're on the left-hand side. That's why. There's no more logic than that. How would you reduce it? Credit. And by the way, cash is an asset. Does cash ever come into a company? Let's hope so. What's the company going to do when cash comes in?
Save.
Well, maybe save it, maybe use it for something. But what are they going to do? They're going to debit it because it's an asset. How about they have cash go out and they write checks? They're going to credit it, of course, right? Oh, but wait a minute, the debits have to include credits. Yeah, that's what, when we record a transaction, you get something, you give up something. So we're going to always do a debit and a credit, at least one of each. Actually, you can do as many debits as you want, as many credits as you want if what? They equal each other. Because you have to make sure the debits equal the credits. You got to stay that way, or your balance sheet won't stay in balance, huh? Simple little system. Okay, so you get the idea of the system, and then we'll layer business on top of it. Okay, so liabilities are over here on the right-hand side. Everybody notice that? That's the left, that's the right. Okay, I'm pointing at the screen on there. Yeah, anyway, that's the left, that's the right. So, liabilities. Increase it with a credit. How do you reduce it? This is too easy to believe. Why? They're on the right. It's that simple. Don't think about it too much once you have it down. You ever written on a piece of paper? Set it in front of you when you do your homework? When you come in and do a quiz, what I'd like you to do is write down this accounting equation. In the first quiz, I bet you know how to do this, probably. Right? Okay, in the first quiz, I'm giving you one of the answers here. Okay, but I already gave it to you yesterday, didn't I? The author gave it to you too. Funny how that works, right? On all your tests and all your quizzes and all your finals, we will have given you all the answers. Think about it. Are you going to do this? Learn, right? Okay, anyway. What I'd like you to do is write that down, although legibly. Write it down. Don't bring a piece of paper with it for the quiz. I want a blank sheet of paper, and you write it down on a blank sheet of paper. But you're welcome to do that before you start the quiz. Everybody got it? I want you to have this ingrained in your soul. Pretty soon you won't be that. Waste of time. How many of you have to have the alphabet in front of you when you're spelling words? Remember that? Grade school had the whole alphabet up on the wall. You know, you're forming words. You can look at it. How many of you have the alphabet sitting in front of you when you're writing? Nobody. Right? Most of the time we don't even use a dictionary. You're going to use spell check. There's some advice for you. Use spell check for crying out loud. And when you do, read it still, because there are multiple spellings for the same word, and it could be spelled right to be the wrong one. God, it drives backwards nuts. Just drives them nuts. So, not me so much, because I'm too easy on you guys. Okay, anyway, so what do you think about equity? Seeing as it's also on the right. Increase with the credit, reduce with a debit. Right, this is too easy. All right, now let's do revenue expense again. Revenue does what? It increases your wealth because you are earning the revenues. You are wealthier. Everybody agree with that? So, as I said last time, this revenue and expense is a subset of equity, right? So handle them as though they were equity. They are temporary equity accounts. You make that connection? So it's just like equity. Revenues increase equity. Equity is on the right. So therefore, equity must be a credit. We increase with a credit, reduce with a debit, right, to keep a credit balance. Okay? So because revenues increase equity, what do? Increase revenues with a credit. That's it. Does everybody get that? This is where the first disconnect sort of happens. I'm going to increase revenues with a credit. Okay? How about if I put too much in the revenue account? I'll debit it to fix it. You don't ordinarily debit revenue accounts, right? When you sell things to people, you don't have less wealth, right? You don't ordinarily do that. It's just if you make a mistake. I put $100,000 in a sales account for sales revenue, and it should have been 90. So I'll credit it for the 100, huh? How do I get it down to 90? Debit it for 10. Everybody got it? This is clicking, right? And you sort of had it when you read the book too, but it's kind of like, oh, okay, fine. You don't have it to a point where you can use it when you read the book, though, either, do you? Those of you who tried this class before, that's true, isn't it? You read the book and it's kind of like, you got to do this, okay? You got to do this. You got to work a bunch of those problems. Debit, credit, what do I have? Is something an asset? Is something a liability? Is something a revenue? Is something an expense? Whoops, equity, revenue, expense. Is something one of those five or not? And everything fits into one of those. Here's the cool thing. There are billions of assets, liabilities, equities, revenues, expenses, I suppose possible, right? But all of them fit in one of the five categories, and as soon as you know what it is, and then you know what you have more or less of it, you know how to account for it. You get it made. So what's the process? What did I get? What did I give up? What is the thing I got? And what do I mean by what is it? Asset, liability, equity, revenue, or expense. Name it, right? And now just record it, because you know what you do, right? You know where they go. And accounting's easy. For people, accounting is either really simple or almost impossible. It's bizarre, right? It's just seeing the model. It's just seeing the model. It really is. Okay. So, how about expenses? Increasing with what? With a debit. And why would I increase expenses with a debit, guys? It decreases your wealth. That's the real reason. It's decreasing your wealth. So how do my wealth is equity, right, guys? This is my wealth. Equity is my wealth. So I'm increasing my wealth with credits, right? I'm reducing it with debits. So expenses, costs, do what to my wealth? What does it do to my net income? It makes it go down. What does that do to my wealth? Go down, right? Actually, I might be in a loss position, right? What would a loss be? When would you have a net loss here instead of a net income? When the expenses are more than the revenues. When the debits are more than the credits, you would have a net loss, which would be a debit, by the way, right? And then what would debit do to equity? It decreases. Easy, easy, easy. Okay, I put too much in expense. Too many debits. At 90,000 debited salary expense. Should have been 7. What do I need to do? Get 20 out of it. What would I do to it? Credit it. Okay, so you asked about an equity statement. So let's do a real basic equity statement. Okay, how come I put that on number 2 instead of number 1? We don't know. All right. Okay, so how long have I been chatting? 9 minutes. Yeah, we'll keep going. Okay, so let's split this equity out a little bit. Oh, by the way, we're done with that question, aren't we? Everybody's got 3 whole points out of 25 for doing this. Okay, let's split that out a little bit. Assets equal liabilities plus equity. Revenues less expenses is net income, right? And remember, net income or net loss is not an account. It's just the difference between revenues and expenses. It's not an account, just the difference. Okay, so equity, though, I'd like you to think about equity, wealth. Do you guys have any wealth? And what I mean by that is, do you have more assets than liabilities? I don't. Kidding. Hopefully, hold it better. Soccer player. Okay, but what's the deal? Do you have more assets than you do liabilities? I bet you do. You're young, you probably do, right? Your parents are generous and your grandparents and stuff. My grandkids have a lot more, right? Assets than they do liabilities. They don't have any liabilities. You give them all the crap they've got. Okay, so think about this. If you have possessions, assets, right, that exceed what you owe against them, you have wealth. Where did it come from? Maybe you retained earnings. What does that mean? You earned and kept it. Right? In a company, we call that retained earnings. Huh? That's, accountants are really clever with this kind of stuff. We call things what they are. Earnings I kept, I call retained earnings. You like it? That's it. It's retained earnings because I kept it. Okay? So one of the sources of equity is retained earnings, guys. Okay, I'm going to give you a T account here. And what a T account represents is a general ledger account. What I've got is the debits here, right guys? And the credits here. And always we can use a T account for any asset, any liability, any equity, any revenue, any expense. And the things that you put on the left side are the debits, and the things you put on the right side are the credits, always, okay? No matter what kind of account it is, they all work the same way. A lot of times students will think, oh no, I can only debit an asset. No, you debit an asset and increase it, you credit and reduce it, okay? You can debit and credit everything, and you do, okay? So don't worry about that, it's okay. And that'll hang people up, because then you get one-sided journal if you want to debit everything or credit everything, nothing. Okay, all right. So anyway, we've got retained earnings, and that represents the earnings that you kept and retained. What's the other source of wealth you guys have? Anybody have any wealth they didn't earn? Of course you do. I don't think I do anymore. Pretty much everything around me I earned. My dad is 88 years old. He hasn't supported me for a while. So where else did you get wealth, you guys? Come on. Well, dividends, if you have dividend income, but that would be part of it. Common stock incorporation, or preferred stock, owner's investment. But think about yourself personally. Anybody paying your tuition for you right now? You're accumulating an asset. Shaking it. No, I haven't. Yes. Maybe the government's helping. That's an investment. Okay, it is. Taxpayers' investment in the future. Yeah, it is. Okay, absolutely. Nobody pays for all their education. Doesn't happen here either. Okay, but anyway, what's the deal? I certainly didn't pay for all mine. I paid it back in taxes. You know what's really funny about that? People don't want to fund higher education. In the year I made the most money, I paid for my education 3 times in taxes. 3 times in 1 year. Was the investment in my education a decent investment? Every year I pay for my education. Every year. Tax. Pay a lot of tax. Make money, guess what? Pay taxes. Right? I think I should pay taxes for you guys to be able to sit here. Not just because I paid because of that, right? But if I wasn't here, I'd pay that. Right? I had there was a woman living across the street from me. It really made an impression. 12 years old or something. She had a sign in her yard supporting the school levy, passive bond levy for schools. And I knew her, and I talked to her a lot of students cookies. And she's a really sweet lady. And I said, well, you don't even have children. Yes, she didn't. You didn't have any grandchildren because you didn't have any children, so I was like a grandchild, And I said, well, why would you vote for paying for schools? And she says, because I love everybody. And I want to live in a country where people have opportunity. And she goes through this whole spiel. Wow. There are people like that don't just want it for them. Really? Oh my God. How could that happen? And what the hell happened to our society? Now everybody wants to not pay taxes and still have everything. Yeah, I'd like to drive around in a Mercedes. I just don't want to pay for it. And I don't think I get to drive in one if I don't buy it and pay for it. What do you think? Pay for everything, you guys. Pay your taxes. Pay your taxes. Anyway, why did I get off on taxes? Okay, anyway. So, people, contributing, yeah. People contributing to the business, what do we call that? Contributed capital and types of contributed capital, right, are going to be what? Common stock, shares of the company, ownership shares of the company that belong to people, pieces of paper in the old days, right? It's kind of electronic. But yeah, representation of ownership, okay? So yeah, they contribute to it. So if you think about it, your grandparents gave you money, right? Parents gave you money, right? People are contributing to you, okay? You are accumulating an asset, your education right now, by the way, as people are contributing to it, and also you're paying for it yourself, right? Well, that's a contribution from yourself, okay? Owners can contribute to the business themselves, huh? Okay, that's what happens. So those are the two sources of wealth, okay? Now let's talk about how net income gets into retained earnings. Net income is the earnings, right? Net loss is negative earnings, and you're becoming less wealthy when you lose money. And then you mentioned dividends, right? What's dividends? It's taking some of the earnings out. You didn't retain it. So dividends a company pays are a reduction of the company's equity, a reduction of the retained earnings. Dividends a company earns are different. They made an investment in another company, and that's dividend income. We'll do that later, okay? That would be more similar to revenue up here that I'm earning from another company, okay, from investment. So we're talking about dividends the company pays. So how does this work? And the idea of doing an equity statement, okay? How does this work? What happens is the net income is going to be added to retained earnings. So if you think about it, when you start the company, your beginning balance in retained earnings would be nothing, right? And then year after year after year, you add the net income. So the net incomes come in from the income statement. And this is called closing. We're going to do it in chapter 3. What's going to happen is you take the revenues and expenses, because these are temporary for 1 year. You take the revenues and expenses and you close them into equity. So you temporarily keep track of the credits here, the debits here, right? Credits increasing equity, debits reducing equity, and then you close them. You make them zero, right? And when you make these zero, the net income gets added to retained earnings to make the journal entry balance. Journal entry is just writing down a bunch of debits and credits on a sheet of paper, okay? And a computer. That's all a journal entry is. It's recording a transaction, okay? So what we do is we accumulate everything on the income statement, the revenues and expenses, for a year, and then we take those balances and we plug them into retained earnings, because that's what they are. They're part of retained earnings, okay? So if you look at a company that's been around a long time, Ford, they started with nothing, right? When they started the company, and they kept adding their net income year after year after year after year. But they don't make net income every year. Some years, what happens to them? They have net loss because their expenses exceed their revenues. And if you have a net loss, what do you suppose would happen? I mean, what we're saying is these expenses exceed these revenues. That'll give me a net loss, right, guys? And if I have a net loss, it is a debit or a credit. Which one? It's a debit. Why? Expenses are debits, revenues are credits. The debits are exceeding the credits, right? So it'd be a net debit, wouldn't it? If net loss is a net debit, what will that do when you close it to retained earnings? It's going to go on the left. And that's why. You don't remember that a net loss reduces retained earnings. You know it does. And retained earnings is what kind of an account? Equity. So how would you reduce an equity account? With a debit. And why is net loss a debit? Because expenses are debits. And they're bigger than the credits that are revenues, right? So you got a net debit. And now your head's spinning a little bit, isn't it? So work on it until it's not. Until it just seems natural. It's normal. It's no big deal. Okay? All right. Okay. So now what we're saying is, look, the company will start with nothing when they start the company, and then year after year after year, they add all their net incomes, and if you'll have one or the other in a year, right? Not both. You'll have net income for the year, you'll have net loss for the year, and you just accumulate. So then what happens? When you look at a balance sheet for a company that's been around 100 years, when you look at their retained earnings, what are you looking at? All their income less all their losses since they started the business. Oh, that's what retained earnings balance is. When you're reading a balance sheet, you don't know what the hell you're looking at. Get it? That's what we want here. I don't care if you know how to get it there, really. If you don't know how to get it there, you probably don't know what it is you're looking at. Right? Okay. What's the other piece? What did you say? Dividends. What's a dividend? It's not an expense. It's a direct reduction of equity, wealth. Let's say you put $100 in a savings account that earns $2 a year, 2%. Interest rates are horribly low. That's high, isn't it? Okay, you earn 2% on your savings account. So you put $100. How much will you have in your savings account? 2%. You have 102. And how much would you say you earned? 2, right? That's it. You'd say your income on it was 2, right? We call it interest credit, interest income. You earn 2, and you have 102. Now take the 2 out. What do you have in the savings account? 100. So now what you'd say is you earn nothing, right? No, you wouldn't. You'd say you earned 2 and you took it out, right? So if the company earns 100,000 net income and they decide to take out 20, what happens? Retained earnings goes up at 100,000 net income, and then down by the 20 the owners decided to take out in the form of a dividend. They're taking some of the profits out. That's what a dividend is. Everybody got it? It doesn't reduce your profitability. It'd be cool if it did, right? What I'd do is I'd say, well, yeah, I made 100,000 last year, right? And I spent it all, so therefore I don't have to pay any taxes because I didn't really earn anything. In fact, it could be better. I could make 100,000 and spend 200, and the government would have to give me money back because I had a big loss, right? I could collect, yeah, sure. Okay, it doesn't work that way, does it? Okay? The fact you spent it doesn't make any difference. The fact the owners took it out. So you get the difference between a dividend and an expense. Go ahead.
Because you can't really tell what you contributed. Does the contributed capital always have right?
It's on the right, but being on the right doesn't mean you owe it. That's really good. That's really a good question. Assets, liabilities, and equity. Is being on the right something you owe? No. Liabilities are something you owe. Equity is what you own. Think about this. All of your assets, either you're still paying for them or you own them. This just represents your ownership. This is what you owe. The fact that it's on the right doesn't mean you owe. Okay? You don't owe the shareholders. The shareholders own the company. They own the assets. They have possession of those assets, control of them. Now, they don't really literally own all of them. If you've got $1 million here and you have 600,000 here and 400,000 here, they really own 400,000, right? The creditors own 600,000 of the assets until they're paid. Right? That makes sense? Okay, good. That's a good question. Okay. All right. So what we'll do, so are the dividends going to be a debit or credit? Debit. Why? You're reducing equity. Retainers in equity account. How do you reduce all the equity accounts, you guys? They're on the right, so how do you reduce them? With a debit. Okay? And so we're going to have an ending down here, and we really hope the ending balance is going to be a what? Credit. Does it have to be? Do companies go bankrupt? Yeah. Oh, yeah, often. Most startup companies go bankrupt. You know why they go bankrupt? What they do is they start with nothing, and then they lose money, lose money, lose money, lose money, and then they go bankrupt. They never make a profit. That's what happens to most of the businesses. It's true. It's risky to go into business. Okay, what would happen? You start with 0 here, and then you have a whole bunch of debits for the losses. You have what's called a retained deficit, a debit balance. So what you end up having is fewer assets than you do liabilities. This is not a good situation to be in, right? Go bankrupt. Risk in business. First case of that. Okay, so nobody reminded me to shut this thing off. Got to really cry. And then how am I going to do that? Start another one? I guess. Yeah. You know what it's going to make me do?